I'm here today with Chris Czarnecki, President and CEO of Broadstone Net Lease, Inc. Chris, how are you today?
Great. Thank you for having me. It's always fun to be part of these NAREIT events.
Investors speculated for many years when Broadstone Net Lease might go public. Can you talk about reasons for making that move now? What are the benefits that you anticipate the company enjoying from this transition?
Yeah, absolutely. Broadstone has long acted like a public company, even while we were sourcing capital privately. And we had planned our initial offering earlier this year and had to wait a little bit for the capital markets to heal and find their footing and whatnot. But during that time frame, our portfolio held up really, really well. So that was a good supporting factor for us to be able to talk about as we approached this market and share the successes we had during a very turbulent time in the market. But for us, an IPO and why we pursued it now was twofold. It was one, a capital raise activity, and I'll touch on that a little bit more. And it was also to gain access to other tools to more efficiently finance the business. And so on the capital raise front, we wanted to really achieve two objectives. One was to continue to position our balance sheet from a spot of strength. We've been an investment grade rated REIT for a number of years now, but wanted to create additional financial flexibility and have more capacity in that front. And then second, it was to be able to get back to acquisitions, which is obviously very important in the net lease space. And we wanted to be able to execute on our pipeline and turn it into actionable acquisitions to grow AFFO per share. And so it was a capital raise for those activities as well. On the tools that we think are really attractive for the long term that we picked up through the transaction, a couple of ones that come to mind would be the high grade bond market. Again, having one credit rating, we would need to potentially get a second, but that's a really great market for the net lease space with long-term fixed rate unsecured debt, matches the net lease model really, really well. And then on the equity raise front for future potential equity raises, we certainly would obviously look towards secondary offerings and overnights, but even more attractively is the ATM programs, the at-the-market programs, whereby we can potentially issue small amounts of equity on a near daily basis. And that fits really well with the net lease model, doing lots of small granular acquisitions and having a high degree of transaction regularity. And so those tools, the capital raise components, were all the reasons why we were thinking about executing on the IPO this year. And we're very pleased to be able to have gotten it completed and being able to move forward with our business.
And what is unique about Broadstone Net Lease? How can you differentiate yourselves in the net lease sector?
Yeah, absolutely. There's more than a few net lease companies, right, out there. For us, first off, I'd like to just highlight that we are a really established platform. We're not a maker REIT. We've been operating in the private side for 13 plus years with a really deep and strong track record. And so for us, this is not so much a change in business strategy. It's really just a continuation in a different format. But a couple of the ways that I think we're differentiated amongst the peer set is some of our portfolio statistics and the portfolio we've put together over the last 13 years, and our weighted average remaining lease term, our best-in-class rent escalations, our very limited near-term lease expirations are all really strong positives for us that I think compare well. And then more importantly, or just as important, is our differentiated investment strategy. We've been diversified intentionally since day one. When I was fortunate enough to join the company in 2009, we were already investing in industrial assets, healthcare assets, which are very unique in the net lease model, restaurants, which are more classic, and retail locations as well. And then even within there, we've built out some very interesting adjacencies within each of those property types, cold storage as an example, or the animal health veterinary space. And all of that gives us a lot of flexibility to pivot and adjust as market conditions change and allocate capital in a really, really effective manner. And then probably the last thing that I like to highlight for folks when we get asked that question is our sizing. I think we're at a really sweet spot for a number of reasons. One, we're certainly large at $4 billion plus of portfolio value, meaningful diversification that I touched on. But we're small enough that external growth, we believe, in line with our historical averages, really moves the needle and can contribute to AFFO growth and AFFO per share growth. And so we love the dynamic of where we sit relative to some of the larger peers.
And finally, what opportunities do you see in the marketplace, and where are you focusing your efforts?
Leading up to the IPO in the third quarter and into the early fourth quarter, we began converting our pipeline into more actionable opportunities. Talked a little bit about where we sit in a strong pipeline last week on our earnings call. But what we're thinking about for the next 12 months is really having a bigger focus on industrial. And for us, industrial certainly is a core part of our holdings. It's about 45% of the portfolio today. We're a little different. We tend to focus on secondary markets, slightly smaller assets. We have some good diversification amongst manufacturing, distribution warehouse, and food processing and cold storage. We also would expect to spend a good amount of time in the healthcare space, which is about 20% of the portfolio. And there we focus really in two unique categories as well. One is the off-campus but hospital-affiliated system property, so integral to the care delivery model from healthcare systems, but not necessarily needing to be on the hospital campus. So urology clinics, more minor surgery procedures, things like that. And we also work with dominant regional physicians groups that are independent of a health system, but might really cover a market or a state well from a specific area of care like orthopedics. And they have multiple locations, multiple doctors and practicing physicians, a professional business staff. And, those are really very attractive opportunities, and we've built up a nice portfolio there as well. So we would expect we'd spend more time in those segments in addition to a little bit on the retail side over the next 12 months in the restaurant space, the fast food space, excuse me, where we're a little bit more cautious. And I think it is fairly obvious given the state of the world today. Casual dining is a spot which is just 7 or 8% of our portfolio. It's been important for us, but we're carefully monitoring our assets and our tenants. And as business models adjust and the winter comes and whatnot, we want to be careful about allocating more capital there. And then on the office side, we also have a little bit of caution. It's a small part of our portfolio, just 17 properties, but think that it's prudent to wait to see how the great work from home experiment goes for a little while longer. But love our existing assets and feel good with our lease duration and our credit behind those, that the portfolio is solid. It's just where do we allocate capital in the future? So that's really how we're thinking about our opportunity set for the coming year.
Chris, thank you so much for your time today.
It's always a pleasure. Look forward to seeing you soon.